Okay, let's just jump right in. Imagine you've been planning for years. You have this important financial contract. Maybe it's a segregated fund for retirement or a life insurance policy with a guaranteed death benefit.
Right.
And now the time has come. You need to claim that value. It could be a simple withdrawal, a planned maturity, or a much more difficult situation like a death claim. How do you actually get that money? And what really determines that final number?
That's the big question, isn't it? A lot of people think it's simple, like pulling cash from a bank account.
Yeah, you just fill out a form and that's it.
But these contracts have layers, guarantees, legal rules, very specific procedures. So our mission today is to cut through that noise and give you a really solid guide to contract claims. We're talking withdrawal, surrender, maturity, and death.
So we're pulling apart the key players, the paperwork, and this is the critical part for me, the financial factors, things like guarantees and tax adjustments that make sure you get what you're actually owed.
Yeah.
And we're really looking at two totally different worlds here. On one hand, you have the really emotional, sensitive side of a death claim, which needs so much tact.
Absolutely.
And on the other, you have these, I guess, routine financial transactions where efficiency is everything. That's a huge gap in approach.
It is, and that gap leads to a really common mistake right from the start. And this is our first big insight. Agents or, anyone helping out should never, ever try to calculate that final payout amount themselves.
Oh, interesting. Why is it so risky? I mean, if they have the current market value, shouldn't they be pretty close?
They might be close to the market value, sure, but they almost never have the full picture. The insurer might have just applied some kind of unrecorded contract enhancement.
Ah, okay.
Or, and this is more likely, there could be outstanding administrative charges or fees the agent just doesn't know about. The golden rule is this. The amount paid is always the contract value or the guaranteed sum minus any of those outstanding charges.
So the insurer has the final definitive numbers.
They do. Trying to estimate it on the outside just sets the client up for a nasty surprise when the numbers don't match.
That's a fantastic piece of advice. Don't promise a specific dollar amount. So, okay, let's establish who has the authority here. Who actually gets to file these different claims?
It really depends entirely on the event. So for any voluntary action, we're talking about withdrawal, a surrender, or if the contract has just reached its maturity date, the claimant is the contract owner.
The primary decision maker.
That's right.
Okay, but what happens if the contract owner can't act, due to illness or incapacity?
Right. In that case, the authority transfers to the person who holds a power of attorney for property, or POA. This person essentially steps into the shoes of the owner for all those financial dealings.
So they can file for withdrawal, surrender, and maturity.
Correct.
Yeah.
And we should probably circle back to the POA later because that relationship has its own really significant ethical and legal rules.
Good point. And then finally, the most difficult event,
Hmm.
a death. Who takes over then?
Then the authority shifts completely. It goes to the people named in the contract.
Okay.
So that means the beneficiary, or if the money is going to the estate trustee.
And that trustee could be the executor or, in Quebec, it's the liquidator, right?
Precisely. The executor, administrator, or liquidator.
So we know who. Now for the how. A lot of people probably assume they have to go through their agent for everything, but that's not strictly true, is it?
That's right. Agent involvement is, it's considered a best practice. It helps with customer service. It minimizes errors. But it is not mandatory. You can order claim forms directly from the insurer.
But I'm guessing involving the agent is a pretty good way to avoid delays, a sort of protection layer.
Oh, absolutely. The agent is like the first filter. They can make sure everything is complete. I mean, both withdrawal and death of benefit forms come from the insurance company. But the key to a fast payout is making sure they go back signed by the right people and with all the attachments.
And once that paperwork is in?
Once it hits the insurer's desk, a specialized claims rep takes over. They handle the final processing, and they issue the payment. Could be a check, could be multiple checks, or a direct fund transfer.
Okay, let's shift gears a bit to the mechanics of ending a contract. There are two main ways this happens before a death claim: termination and surrender. How do we distinguish those for the listener?
They both end the contract. That's the key similarity. But termination is scheduled. It happens automatically because the contract has just reached its full predetermined term, its maturity date.
And surrender is?
Surrender is the client actively choosing to end the contract early before that maturity date.
So one is an expiration date, the other is cashing out early. Got it. But in both of those situations, the contract owner gets some choices for what to do with the money, correct?
That's right. At termination or surrender, the owner can decide to take the value as cash, or they could say purchase an annuity.
To turn it into an income stream.
Exactly. Turn that lump sum into a steady income. Or they can pick another option if one is offered in the contract terms.
Okay, but we need to flag a big regulatory detail here, especially for anyone with retirement funds in locked-in accounts. I'm thinking of a life income fund, a LOF or an RLIF.
This is a critical nuance.
Yes.
If the account is locked in under provincial or territorial law, the owner might be legally blocked from just taking the cash.
Why's that?
The government wants that money to be used for retirement income, not as a lump sum you can spend right away.
Yeah.
So the value often must be transferred to another qualifying locked-in account. The cash option just isn't always on the table.
That's a really important distinction, and it sets us up perfectly to talk about the core promise of these products, the guaranteed benefit. This is the whole protection against the market going down, and it kicks in at maturity or death.
And the mechanism behind this guarantee is, I think, what's really fascinating. It's a contractual promise, usually defined as a certain percentage of your total deposits. But, and this is the key, this guaranteed value is dynamic. It doesn't just sit there.
Right. It gets adjusted in two directions. This is where planning really comes in.
Precisely. It's adjusted upwards anytime the client uses a feature called a reset. So if the market value of your fund grows to be more than your guarantee, you can often lock in that higher market value as your new higher guaranteed minimum.
And the other direction is the crucial one. It's adjusted downwards with any withdrawals you make. This is the financial gravity people really need to get.
That is it, exactly. When you take money out, you aren't just lowering the market value, you are literally chipping away at the foundation of that guaranteed promise. If you spend decades building up a specific guaranteed death benefit, even small withdrawals will mechanically erode that guaranteed floor.
It's a huge long-term cost for getting cash early.
A huge cost.
But this is where the magic of the insurance company comes in. If the market has performed badly and the contract's actual market value is less than the calculated guarantee when it's time to claim,
then the insurer contributes the difference. They top up the payout. They make sure the guarantee is met. The guarantee is a floor. But if the market value is higher than the guarantee, you just get the higher market value.
So you always get the greater of the two.
Always. The greater of market value or guaranteed value.
That's a very clear way to explain the protection. Let's go back to the death claim procedure, which, like we said, needs incredible sensitivity from everyone.
It really does. When you're helping a grieving beneficiary or an estate trustee, the focus has to shift completely from, transactional speed to just empathetic guidance. The whole process is started by the claimant, the beneficiary, or the trustee.
What are the absolute must-have documents? The things that, if they're missing, will cause a huge delay?
Well, the documentation is non-negotiable, and it's very rigorous. You need the contract number, the claimant's signature, the agent's info. But the two most critical proofs are, 1, the official proof of death form, or the attending physician's statement, the APS.
Okay. And number 2?
And number 2, the original death certificate.
And you're emphasizing original there. I'm guessing photocopies or, unofficial translations cause massive slowdowns.
Massive, huge slowdowns. And if the death happened outside the country, you need to be prepared for even more documents. You might need translated and notarized foreign death certificates, which just adds more layers of complexity and time.
So completeness and accuracy are just paramount.
Especially then. You want to get the claim moving quickly during what is already such a stressful time.
Okay, let's pivot to what might be the most versatile and maybe the most common claim type. The withdrawal.
The withdrawal form is a real workhorse. It's used for two very different things. Taking a partial withdrawal while the contract stays active, or a total withdrawal, which is a claim that closes the contract for good.
And right there on that form, there is a distinction the client has to make that can cause a lot of problems if they get it wrong. The difference between net and gross.
Oh, this is a huge point of confusion. And it's a common source of frustration for clients. The client has to specify if the amount they're asking for is the net sum, so the exact cash they want in their bank account after all charges, fees, and withholding taxes are taken out. Or the gross amount, the number before any of those deductions. If they ask for a gross amount equal to the market value, for example, they're going to get less than they expect. And if they don't specify, the insurer has to follow up, and that just causes delays.
Okay, what about signatures? Who needs to sign off on that withdrawal form?
You need the contract owner, obviously, but, and this is a big one, if there's an irrevocable beneficiary on the policy.
Meaning you can't change them without their permission.
Right. Then that irrevocable beneficiary must also sign the withdrawal form. And on top of that, the agent needs to sign off, and they have to note the exact date and time the client gave the instructions. Plus, clear payment instructions. Check, direct deposit, or a transfer.
And this form isn't just for one-time withdrawals, it's also the main way you manage ongoing income streams, isn't it?
It is. It's the central control panel for everything. You can use it to set up a scheduled withdrawal plan, an SWP, which is essential for RIF payments, or you can make tiny adjustments. Well, you use the same form to change the amount or the date of your scheduled payments, to change which underlying investments are sold for those payments, to update your banking info, or just to stop the payments altogether.
But even with all that flexibility, there are still some regulatory walls, especially for those income funds.
Correct. The government sets mandatory withdrawal rules for retirement income. RRIF contracts, for example, require a minimum annual withdrawal. And if you're dealing with a locked-in fund like a LIF or an RLAF, the rules are even tighter. You have to meet that RRIF minimum, but there's also a legislated maximum you can't go over.
So you have a floor and a ceiling.
Exactly. A floor and a ceiling.
So we've covered the owner, the beneficiary. Let's circle back to the legal complexity of the power of attorney for property. You said this is where agents can get into a bit of an ethical bind.
This is a really high-stakes situation. The POA document appoints a substitute decision maker for the owner's financial property. The instructions from the person with POA must, in almost all cases, be respected, just as if they came from the owner directly.
But there are limits.
There are. A common legal distinction is that a POA for property generally can't make highly personal decisions, like changing beneficiary designations. That's usually outside their scope.
And the agent has a clear professional duty if they suspect something is wrong, right? Like if they think the person with the POA is trying to drain the contract against the owner's interests.
Absolutely. The agent has an ethical and professional duty to immediately raise that concern. They have to talk to their manager or supervisor if they suspect the POA is not acting in the owner's best interests. That is not a gray area. It's a firewall to protect a potentially vulnerable client.
And because these POA documents can be so different from place to place,
We have to stress the legal caution here. Provincial and territorial differences in the scope and activation of a POA are significant. In any complex situation, especially one with large sums of money or suspicious activity, a professional legal opinion should always be sought before you proceed with that claim.
you have to be absolutely certain they have the authority for that specific request.
You must be.
That's critical context on the legal side. Let's wrap up by coming back to the financial side of things. Let's talk tax implications, specifically how investment performance affects the final value and the tax bill for non-registered contracts.
Right, this is the financial engine room. When a segregated fund generates investment income, interest, dividends, capital gains, or losses, that money stays in the fund, and it directly impacts the unit value.
But the key step for tax purposes is the annual allocation.
Exactly. This income and any gains or losses are allocated out to the contract owners every year. And for non-registered investments, this annual allocation increases or decreases the investment's adjusted cost base, or ACB.
Okay, for the listener, let's break that down. The ACB is basically your starting price, what the government considers your cost for the asset. Why does adjusting it every year matter so much?
It matters because it prevents you from being taxed twice on the same money. When that income is allocated to you each year, it gets included in your taxable income for that year.
So you've already paid tax on it.
You've already paid tax on it, so your ACB is adjusted upwards to reflect that. Consequently, when you eventually withdraw the funds, that part of the growth has already been accounted for. You're only taxed on any new gains, not on the income that was already allocated and taxed. It keeps your tax liability efficient.
And that brings us to the end of our deep dive into the claims process. I mean, we started with the paperwork, we navigated the legal traps, and we ended up with the critical tax architecture.
The blueprint is pretty clear. For a learner, I think the core takeaways are professionalism and efficiency are key in standard claims. You have to get the net versus gross right, get the signatures. For death claims, it's mandatory sensitivity and being rigorous with documents. And finally, you have to understand that your contractual guarantee is not static. It's mechanically adjusted downwards by every single withdrawal you make.
So we've seen that the guarantee value goes down with early withdrawals. And we just talked about how allocated investment income for non-registered funds raises your adjusted cost base, making future withdrawals more tax efficient. This kind of raises an important question for you to think about as we wrap this up. Given this interplay, how does the strategic timing of an early withdrawal, which might sacrifice some of that future guaranteed protection, compare to the long-term tax benefit you get from that upwardly adjusting ACB?
It's the balancing act, isn't it? The trade-off between guaranteed protection on one side and immediate tax efficiency on the other, it requires some real strategic thinking, something definitely worth mulling over.
Absolutely. Thank you for joining us on this deep dive. We'll talk soon.